Very warm welcome to you as you join us on today's episode of Tax Matters. My name is Olumoyiwa Matuluko. My personal experience on this beat, reporting taxation matters and presenting this program, Tax Matters, is that no matter the topic of the day, no matter the issues thrown up in any episode, more and more people, most of the respondents, most of the people that call us to talk about any issue, will talk about personal income tax. And that is because personal income tax is that one that concerns everybody. Because your personal income tax comes out of your own purse. And so on today's episode of Tax Matters, we're going to be looking at issues surrounding personal income tax administration in Nigeria. And our guide is Mr. Peter Olayemi, the Director, Individual and Enterprise Income Tax Department at the Federal Inland Revenue Service Headquarters in Abuja. Mr. Olayemi, welcome to Tax Matters.
Yeah, good day, Tax Matters. How are you today?
Thank you very much. We said in the introduction that you just released a public notice on 2013 personal income tax return. And the question that readily came to our mind is why at this time?
Yeah, thank you very much for that wonderful question. The public notice is just to remind taxpayers of their obligations under the Personal Income Tax Act as amended. Because in the law, all individuals, any income, have the obligation to submit their returns, once every year. Now the publication is to remind all of them that they have obligations to make an income declaration at the beginning of the year. And this income declaration is supposed to be submitted to the tax office on or before 90 days from the commencement of the year. That requirement, affects everybody, whether you are in paid employment or you are self-employed. Everybody are supposed to file their returns to declare their income from all sources. That is the provisions of the law, and that is what we are trying to remind people, that they have that obligation, and the tax authority can actually, call them to question if they fail to discharge that responsibility. That is on the part of the individual taxpayers. Now, for the part of the employers of labor, the law expects them, or let me put it this way, pay as you earn is a collection mechanism that is similar to the withholding tax that corporate organizations deduct from contracts due to their contractors. So PAYE is a deduction on a monthly basis of taxes due on the remuneration paid to the employees. But at the beginning of the year, when the individual file a return of their income, they may not even know at the beginning of the year whether they will earn some other income, like overtime, like bonus, or whatever. So because, in calculating the tax, the employers are supposed to be deducting from the emoluments of their workers, which was given to them at the beginning of the year. It will now be necessary to now say, okay, at the end of the year, when you have treated, you have paid all the dues to the employees, you have done everything, then by the time you now want to render the return for December of that year, the law expects the company to do a return where the company will state all the emoluments from whatever sources paid to the employee now calculate the tax due on that global income. Then they will now deduct the amount of tax they have deducted on monthly basis from January to November. Then the difference between the total amount of tax payable for the year and the total they have deducted on monthly basis will now be deducted to arrive at the rendition, the amount they will now remit for December to close the activities of the year. So that is one of the other things we want that public notice to achieve, to remind the employers of labor that they have the obligation to file their returns, stating all the activities of year 2012, so that, by the time that return is filed, the account reconciled, then we can now assume, subject to, anyway, the powers of the revenue to still, look at the records, the last 6 years, to close the activities for that year before they will now start what the tax renditions and the declarations for year 2013.
Thank you, sir. We recorded that before we came on set, we were discussing this same matter, and we were saying that the notice affects the employee differently from the way it affects the employer, like you just beautifully explained now. And that also goes as far as the dates. What is different in the dates to which this notice applies to the employer and to the employee?
Thank you very much. The employees are allowed a period of 90 days within which to go to the tax office, collect Form A, which is a form they will use to declare their income from all sources, and return to the tax office before 30th of March of the current 90 days from January 1st. Okay. Now for the employers have only 30 days. That is to file the annual returns for the preceding year, right? So that before the end of January of the succeeding year, they are supposed to have done all that they need to do to properly render their return of tax deductions from the emoluments of their employees, and this rendition must be completed on or before 30th of January of a succeeding year. That is what happened.
But then that employer has been deducting and remitting to the tax authorities on a monthly basis. So what is there to report again in January?
Now, we call it return. That is, we want him to make a return of all his activities for the preceding year. And, we said PAYE is a collection instrument. People pay on a monthly basis as they pay the salary. And the salary, the period of 1 year is 12 months. They will have paid the salaries, paid any allowances, pay all dues to the employee as at the end of December. The December return is actually due before the end of January, so that by the time they are now preparing the December return, they will make sure that all the shortcomings, short deductions, or additional payments that the employees received that was not factored into their declaration at the beginning of the year, they will have the opportunity to aggregate everything, calculate the total tax due on all the emoluments received by each employee for the year. Then they will now deduct what the amount of tax they have been deducting from January to November. So the balance becomes payable latest by the end of January. Okay. I think that is just the reason why we are now saying the employer should complete the return filing process on or before 30th of January of a succeeding year.
Now, a large proportion of residents of the Federal Capital Territory from whom you collect this personal income tax are employed by ministries, departments, and agencies. Why would you want these individuals to come forward to fill Form A and come and submit when, in actual fact, the salary of the average civil servant is known, and on a monthly basis, the ministry or department or agency remits? Are you expecting everybody to come over?
Yeah, there is what we call an agency responsibility on the part of the employer, whether a government agency or a corporate organization or even individual who is an employer of labor. The law, even that position, is also stated in the Constitution of the Federal Republic of Nigeria, where it is said that it is the duty of every citizen in the country to declare his income honestly to appropriate and lawful agency and pay his tax promptly. That is the Constitution. So it is every individual that has the obligation. It is every individual that know the income that he receives. The employer will only know the employment income that an employee receives. The law says all income from all sources have to be declared, and the sources we have in mind could be from investment income, dividend, rental income. Then it could also be income received from vocation. If you have a little garden at the back of your house and you are selling vegetables, the law expects you to aggregate the income generated from this vocation and declare it to the relevant tax authority. So if the employee are not made to do this income declaration themselves, the employer may claim that, okay, they don't know all their sources of income, but the employee has the obligation to, he knows all the streams of his income, and that is why they now place the obligation on him to fill that Form A, declare all his income from all sources, legitimate sources anyway, and then file that, submit that Form A to the relevant tax authority. Okay. Based on the submission of, based on the declaration of his income on Form A, the tax authority will now prepare what we call a yellow card. The yellow card will show, the total amount of income on monthly basis that, the employee has declared. It will show the monthly tax payable based on that his declaration, and they will now leave a column for the employer as they remit on a monthly basis. They will now be filling in, the tax they are deducting from the salary of each employee, such that by the time they are ready to file their annual returns, they will have filled in tax deductions for 11 months. It will only remain that of December, which by the time they now complete the aggregation of all income paid to that particular employee, they now calculate the tax due for the whole year and now, remit to the appropriate tax authority. It is that amount of remittance in December that will, in January, that will now be entered in the December column or December row of that yellow card. So it is when they have completely filled that form that they will now send the form together with their return to the tax authority, for the tax authority to be able to review what they have done, whether it is right or there is any observations which the organization will have the opportunity of addressing going forward. But the most important thing is that that return must be submitted on or before 30th of January, so that the tax authority will have opportunity to look at it and raise issue if there is any.
You spoke earlier about the self-employed.
Yeah.
Because it's straightforward enough when you're talking about those who are in paid employment, who receive monthly salary.
Yeah.
Now, for those who receive monthly salary, their taxes are deducted monthly and remitted to the FIRS for the Federal Capital Territory in this case. Now, for the self-employed, does he pay monthly? Does he pay yearly?
Well, there is one general misconception that I want to seize this opportunity to correct. Anybody who is doing business, whether as an individual or as a corporate body, has the obligation to prepare an account of the transaction that he generated during the currency of a particular year. It is this return, it is this account that will form the basis of the return they are going to remit or they are going to file in the relevant tax authority. But what do we have now? You describe that a lot of the self-employed believe, their obligation is just to fill the Form A without supporting it with an audited return. So, in addition to filling the Form A, which is required to be done on or before 30th of March of a succeeding year, the self-employed also have an obligation to get an audited return of his activities in the preceding year and attach it to the Form A as a basis for the income declaration on that Form A. But presently, majority of the self-employed will just go to the tax office and say, okay, this is my income, without, submitting anything to prove the authenticity of the income they are declaring. So going forward, we want to appeal to all taxpayers, whether residents in the FCT or even anywhere in Nigeria, that they have the obligation, once they are doing business, they have the obligation to prepare the financials, profit and loss account, balance sheet, and all the rest of it, to actually, provide the basis for whatever declaration they are making on their Form A that will be submitted to the tax office.
The question still remains. For the self-employed, they pay once in a year. Is that not tough on them, as opposed to the one is in paid employment who is able to pay on a monthly?
Well, there is a provision in the law that allows the relevant tax authority, if the amount is too much, to pay instrumentally.
Okay.
Yes, there is a provision for instrumental payment, that is available to the self-employed to pay, in bits. And again, if a self-employed, handles contracts or whatever, withholding tax will have been deducted.
Yes.
And this withholding tax deducted can also be used to defray their future tax liability.
Okay.
So, technically speaking, we can say they also have, an opportunity to pay their taxes in a sort of, instrumentally, and do it in a more convenient way. There is no hard and fast rule, but the issue is that if the amount is too much, you can always apply for instrumental payments.
Thank you, sir. We'll go for a short commercial break. When we come back, we'll still be discussing personal income tax administration, and our guide will still remain Mr. P.A. Olayemi. Don't go away.
Chineke me, they don't increase my salary money. No be mistake. Oga accountant do so.
Papa Junior, you never hear of Peter.
Now the new MD be that. Talk now.
Peter, na Personal Income Tax Amendment Act wey Mr. President just sign for law to better the life of him people. So them to go get more money to enjoy with them family. You see this amended act, they don't reduce the tax we do on top your salary money. They can't increase consolidated allowance money where we go to get every month. And you know, say, now the president where they listen if you do better thing for the people.
Ah, Mr. President, you do well, oh. I'm blessing you, they think of me when you they sign this bitter. Now I feel do boku things this year. I feel rent shop for Mama Junior, buy textbook for Junior, send money go village, make the thing begin build my house.
So, you say I'm going to be landlord?
Of course. Oh, you think so I call country for you? Peter, Peter, hey, Peter.
JTB, creating a tax-friendly environment.
Welcome back. The program is State Tax Matters, and we are looking at personal income tax administration in Nigeria. And our guide is Mr. P. Olayemi, the Director, Individual and Enterprise Income Tax Department at the Federal Inland Revenue Service Headquarters in Abuja. Now, sir, in the year 2011, an amendment was effected to the Personal Income Tax Act. And even before then, we started hearing about consolidated salary and all that and all that. That is to say, the salary of the employee is added together globally and then charged tax. Can you shed more light on this and other matters, other changes that came in with that amendment?
Thank you very much, sir. Prior to the enactment of that law, computation of personal income tax have been viewed to be very, very complicated. And there were a lot of controversies, as to which element of the income is taxable or not. Some people are of the opinion that allowances generally are not taxable. But as you are aware, allowances are taxable up to a certain limit, in the old law. Now there are some professional groups, medical doctors, lecturers in the universities, that believe their call duty allowance, their, some teaching allowance, and all the rest of them are mere allowances that should not be assessed to tax. And the tax authorities always face this challenge in convincing them that for any allowance to be tax exempt, it must be clearly stated in the provisions of the law. Taxation is about law. Anything that is not in the law cannot be enforced or enforceable, either by the tax authority or by the taxpayer. So, I think one of the objectives of the amendment that was signed into law by Mr. President in June 2011 is to at least, remove all these controversies and now say that whatever income, emolument, gross, everybody should know his own gross income.
Yes.
Anyway, irrespective of the components. So the gross income will be aggregated. The basic point is that they want the implementation of the law to be as simple as possible so that everybody will be clear in their minds of what the law says and what they are expected to do.
So, arising from that amendment, there is nothing like housing allowance taxable up to a limit of 150,000, transport 30,000. You add all together.
Everything should be aggregated. What the amendment, passed into law is that every individual will be granted a consolidated relief allowance, they call it CRA, which is computed by looking at 200,000 as a bulk amount, and to that 200,000 is added 20% of the gross income total. So the summation of 200,000 plus 20% of the gross income becomes the consolidated relief allowance per annum on a yearly basis.
On that note, we draw the curtains on today's episode of Tax Matters. We want you to have a blessed week. Don't do what I won't do. Pay your taxes as I won't do. Have a blessed week.